Welcome back. And now Aspen says it has been a challenging year for its manufacturing unit, with performance being significantly impacted by a material contract dispute. But the multinational specialties pharmaceutical company seen sustained strong momentum in its commercial pharmaceuticals business. CFO Sean Capazorio joins us now for greater perspective on that performance. Thank you so much for your time, Sean. Let's actually start off with the highlights. It would seem that the green shoots were contained in the commercial pharmaceuticals business. Would I be correct in that assessment?
Absolutely, and that is our core business. I think 70% or more of our revenue is in that segment, and more than 90% of the profit is in that segment. So that is our flagship segment, and so we had a lot of green shoots there, and we're looking for those green shoots to start growing going forward. So we had a good year there. The only impact we had in that business was the strength of the rand against all the emerging market currencies. So when you look at our performance in reported currency, it would dilute that performance. But if you look at it in constant exchange rate, which is when you're looking at it in local currency, we grew turnover 10%, and we also grew our EBITDA by 10%. So very, very pleasing performance from commercial pharma, and we ended up with an operating profit of around just under 9 billion rand for the year. So I think well poised for strong growth going forward as well.
It's very interesting how economics works because a lot of us would be happy that the rand has strengthened. But I guess for a company that does operate in other currencies as well, that does translate into a negative impact. Sticking to that commercial pharmaceuticals business, of course, the GLP-1 drugs are all the rage. How has the runway been for Eli Lilly's Mounjaro in South Africa since its launch?
Wow, that's been a real success story. As you know, we went into a collaboration with Eli Lilly and took into a partnership in January 24. And so this has been the first full financial year with their portfolio, and we were very happy to be able to have launched that product in December of 24. Feels like quite long ago, but it's really gone quickly. And over the 6 or 7 months, we've really performed very, very strongly with that product. I think the market share is around 41% of that market, and in fact, Mounjaro has actually grown the whole, what they call the GLP-1 or the semaglutide market over that period. So a really strong performance, and the very exciting news is that we have now received what they call the quick pen approval, which is the 4-dose a month pen. It was in a vial, and now it's going into a pen, and then we'll be able to launch that to the market very soon. And we're also just waiting for the chronic weight management indication approval. And once we've got that, then we'll be able to, get access to obesity patients as well to treat their chronic obesity. So I think we're excited for what we've done, and we're very excited for the way ahead for that product.
And another point of focus in that business has also been the restructure of the China business. That has been completed. How much of a lift can we expect from that facelift in FY26?
A very strong one. I think we enjoyed this year. We enjoyed the benefit of bringing the extra revenue in China with the acquisition of the Sandoz business. However, we had to absorb a duplicate expense base. I think we've now restructured that business. We've got a new management team in, and we've got a better diversified portfolio now with the Sandoz products on board. So I think with that leaner expense base and a critical mass of revenue behind us, we are looking for quite strong growth from China. In fact, we do foresee profit growth outstripping revenue growth for the Chinese business in the year ahead. And that trend will obviously benefit the whole of commercial pharma as well.
Well, let's shift gears and talk about the impairments then that led to Aspen posting a loss in this reporting period. What was the difference in FY25?
It's all down to tax rates. I think a lot of people might have heard that there's global minimum tax legislation that's been introduced. I think South Africa introduced it about in January this year, and they've made it retrospective. And Mauritius, which is where a lot of our intellectual property is based, also introduced it recently. And so when we're valuing our intangible assets, we have to value it now at a 15% tax rate instead of the lower tax rates that we would have had historically. and that has obviously reduced your after-tax cash flows when you value these assets, and that's caused the impairment. So it's very much an accounting entry. It's not a cash entry,
Okay.
but unfortunately, with those type of accounting entries, it does put you into a loss position. If you had to strip that out and look at our normal level of impairments, they were very comparable year on year, but unfortunately, with this tax rate and the accounting implications, we had to book a provision for that impairment.
Well, let's drill into one factor that has been on the lips of investors for the past couple of months, and that is the contractual dispute for mRNA products. Because it is ongoing, could the negative effects spill over then to FY26?
Well, I think the negative effect we've obviously taken this year, and that would have been a multi-year contract. So the benefit that we would have gotten from that contract over the next 2-3 years of the runway of that contract will impact future years. However, in terms of short-term impact, it's mainly impacted us this year, and we've now modified our manufacturing strategy so that we're able to reset our strategy and try and recover that loss through other initiatives over the next 2 years.
Talking about modifying, just lastly, as we wrap up the conversation, modifying the manufacturing strategy. Of course, Aspen does say it is focused on optimization strategies for that manufacturing business. What does that look like?
Look, what we've got to do is we've got to make sure that we've got a certain number of contracts in front of us. So one of the big contracts is the one in our South African facility for human insulin. And so we're very excited that, we've now passed the technical phase of that, and we've started production of that product in our facility. So that will give us quite a lot of traction for 26 and then going on to 27 in terms of revenue benefit. And obviously in the short term, we've also got to make sure that we optimize our costs and our processes so that we match that revenue. And over the term, as the revenue picks up, we match the cost with the revenue. So it's really about optimization of costs and revenue in the manufacturing segment.
All right. Well, we do have to end the conversation there. Thank you so much for your time and giving us more detail on those numbers, Sean. Really appreciate it. That was Aspen CFO Sean Capazorio.